Okay, welcome to Accounting 101, our second lecture, finishing up Chapter 1 and getting into Chapter 2. One of the things we have to finish up in Chapter 1 is talking about the financial statements. There are 4 of them. First one is the income statement up here. Second is the statement of retained earnings. The third one is the balance sheet. The fourth one is the statement of cash flows. We have to prepare the statements because we need the result of the income statement to prepare the statement of retained earnings. We need the result of the statement of retained earnings to prepare the balance sheet, and we need information from all 3 of those plus other information to prepare the statement of cash flows. Now, we're only going to be concerned in Accounting 101 about the income statement, the statement of retained earnings, and the balance sheet. All we need to know at this point in time of our accounting education is that the statement of cash flow exists and a definition of it, and that'll suffice. It is the last statement to be required coming into being in early 1970s, 72, 3, 4, somewhere around there, right when I was studying accounting. Before that, historically speaking, if you look at things, you read the Bible or whatever, old literature, people were concerned about, back when, history first started getting recording, we had the landowners and the people that worked the land for them, the serfs. Everybody was concerned about how much wealth a person had. Okay, how much land, how many cows, how many chickens, how many vines, how many olive trees and fruit trees and all that kind of stuff, how many cows. And then as society and the business in society started progressing, and we had the advent of partnerships and corporations, we needed a way to measure income so we could figure out which partners and shareholders, how much money they got. And we got more concerned with income versus net worth. 2 different concepts, closely related, but again, different basic concepts. Net worth is having a lot of things. You can be a millionaire and be retired and not have any money coming in, no income, but you have $1 million, you're a millionaire, or $1 million worth of assets. On the other hand, you may not be a millionaire, but you're working and making $100,000 a year, so you have income and may not have a lot of assets. The best of both worlds is to have both. Have a good, strong balance sheet and have a good, strong income statement. Have a lot of income and also have a lot of assets. Okay, the income statement. One of the things you're going to hear me say over and over this semester, and you'll probably get sick of hearing me say it, is one of the reasons I went into accounting is because it's based on the accounting equation, so it's pretty much pure logic. And also, we accountants tend to give names to things that are somewhat descriptive of what the thing is and or what it does. Unlike a lot of the sciences that they give these fancy Latin names to in biology for different species of plants and animals, and different names to things in the periodic chart of the elements like beryllium and I can't think of the other, 103 elements there are now, 104, maybe 106. I haven't been paying attention to physics lately in the last several decades. But you have a lot of those weird names. Accountants, practical, reasonable, logical people, we tend to give names of things that are somewhat descriptive of what the thing is and what it does. And you'll see that over and over throughout the semester, and I'll repeat it over and over until you get sick of hearing about it. So the statement of retained earnings shows the beginning of year balance of retained earnings, I'm going to give you one of my abbreviations now. And the changes to it during the year to arrive at the end of year balance. Of retained earnings. The capital R/E is my abbreviation for retained earnings. We'll be using a lot. I had a file that I was going to send out to you folks and also give to my day classes, face-to-face classes, of abbreviations I'll be using. But I went in to do it and the file was corrupted, so I couldn't get to it. I'm going to have to redo that. So here, the statement of retained earnings is simply it's the shortest, easiest statement to do. It is the beginning of year balance of the retained earnings account. The changes to it, increases and decreases to it from transactions that occurred during the year. And then the result is the end of year retained earnings balance. The things that change retained earnings are it is increased by net income, decreased by a net loss. That's why we have to do the income statement first, so we can find out what the net income or net loss was for the year to either increase or decrease the beginning retained earnings. And the other thing right at this level is dividend payments will reduce retained earnings. Okay, there are other things, but that's intermediate accounting that'll affect retained earnings. That's the only three things that we're gonna be concerned with. Net income increases it, net loss decreases it, payment of dividends decrease it. The balance sheet is simply a listing of a entity's assets, liabilities, and equities. Yeah, it might sound familiar. So there it is there, the definition. Balance sheet is a listing of business entity's assets, liabilities, and equities. Yeah, it looks like the accounting equation. That's what it is. Assets equal liabilities plus equity. The statement of cash flow shows the cash inflows and outflows during the year from operating activities, investment activities, and financing activities. Now, aren't you glad we're not going to do much with it this semester? It is the most difficult statement to do. The other three are really quite simple, as we will see. In fact, in Chapter 1, they give an example, some very simple rudimentary income statement, statement of retained earnings, and balance sheet. Now, there's a prescribed format for preparing these, which we will go over and we will be doing throughout the semester. The book talks about them. I'm sure I mentioned it in the highlights. It's probably covered in the PowerPoints. You'll read about it in the textbook. You'll hear about me talking about it in this video lecture. The income statement, and again, some of these things have different names that different textbooks or different people in different parts of the country may refer to them. But everybody knows what they are by the several names if you're an accountant. The income statement sometimes is called a statement of operations. It is also known as a P&L, profit and loss statement. The statement of retained earnings, there is no other name for it. That's the one and only that I know of. The balance sheet is sometimes called the statement of net worth, okay, because it shows what you have, what you owe, and how much is leftover residual for the owners. The statement of cash flows shows the cash inflows, that is where cash came from, the sources of cash, the cash outflows, where cash went, the uses of cash, and it breaks it down into three parts. From operating activities, that's your normal, what you do for in the course of business, day in, day out, 365 days a year, 24 hours a day if you're open, if you're Denny's restaurants, I guess. Although they did close for the changing of the millennia, I believe. Found out they didn't have any locks on the doors, for the doors. Operating activities, investment activities is buying and selling of assets. Financing activities entails borrowing money and paying dividends. In a nutshell, there's a little bit more than that, and it's a complicated statement to do. That's why it's not covered in Accounting 101. Okay, if you're interested in it, I believe it's in Intermediate Accounting 3 at the beginning of the semester. So you'd have to take this course plus 2 more accounting courses before you get to work on a statement of cash flows. Okay, all right, that pretty much concludes. There is a financial ratio at the end of chapter 1 that I don't have access to right now. But at the end of each chapter, except I believe there might be one chapter where we don't get a financial ratio introduced by the authors. Some end of chapters, the last thing they do, most of the chapters, they introduce a financial ratio or two. And what a financial ratio is just taking an element or a combination of elements from the financial statements and making a ratio, a fraction, and putting some other elements underneath it. And you get a statistic that is, and it's like all statistics, it's only good relative to something. And we'll cover those in the future. In fact, in the end of chapter assignments, I think we do the current ratio in chapter 1. But they're very useful to financial analysts and other people, investors, creditors. Things like how liquid a company is, how profitable, their gross profit percentage, days in inventory, collections of inventory, how quick you sell your inventory, turnover ratio, accounts receivable, turnover ratios, all these good things. And again, we'll be getting to those at the end of each chapter. Now, what we're going to be doing in chapter 2, they talk about the theory of accounts. Now, what an account is just a place where we put information, and we can put information in and we can take information out. Now, last time we met, I advised you to make up a capital T, and I'm going to send papers out with these on, and you can print them out to use, and that's an account. But I gave you this one with the normal balances on the top, and this is important for writing journal entries, recording a transaction. And then underneath in parentheses, I said what needs to be done to increase an account. And then I said put debit on the right side, or DR is the abbreviation, or CR on the right side, or write the word credit, something like that. And then I put in the types of accounts, the 6 basic types of accounts that there are. Assets, expenses, dividends. Then on the right side, we have our liabilities, our revenues, and our equity accounts. Okay. This is very important. This is going to help you when we're doing our end of chapter assignments. It's going to help you on the exam when we're preparing journal entries, when we're recording transactions. Because what we have to do, the first thing, I'm going to write some rules down here, steps. Step 1. When we encounter action, what we recorded, we had to analyze it before we write it into the general journal. We'll talk about what a general journal is in a little bit. We have to identify the accounts involved in the transaction. Okay, step 1. Now let me put step 1 here. I just have one here. Make it official. Make it step 1. Okay, first thing we have to do, the first transaction we had that they showed us in chapter 1, they showed the same 9 entries. In fact, I think they go up to 17 in chapter 2, which we won't get to today. We'll get in the next video. But the first transaction was Sheena Bright taking $30,000 out of her checking account and putting it into a checking account owned by the corporation she started, which is called Smart Touch Learning Incorporated. Okay, now she's the owner of the corporation. So she didn't change her net worth or anything, and the corporation hasn't done anything yet to increase her net worth or decrease it. The only thing is she's taken her money out of her account, her personal account, and now it's in the account of Smart Touch Learning. It's in the corporation account. So what happens there? Well, let me get these other steps down first, then we'll talk about these transactions and walk through them, and we already did the journal entries, but we'll repeat them, or if I can find my paper with them on, I'll bring it up and we'll talk about these things. Step 2 is determine which of these accounts are being increased that would be added to, or decreased. Subtracted from. The third step then, step 3, is to using their normal balances debit and credit the appropriate accounts. Step 3. Final step. Oh, I didn't put a 3 in there. I did now. Step 4 is easy. It's usually given to you, or you can compute it given the information they give you. Is by how much? And simply meant, what I mean there, by how much is How much are we increasing or decreasing an account by? Okay. Now, as I said earlier, I think I did, an account is merely a place where we put information. It can be a written book. That's what it was back in my day. Now it's almost always a computerized file. But I'm going to be sending out some papers or copies of things for you to use. And one of them is a paper with what we call T accounts. We're going to be using T accounts a lot this semester. Still use them when I do accounting stuff. It helps you analyze things. Now, I'm going to send you a paper. It's a lot neater than this because I did it in Excel and it's bold type and all. And you're just going to have all these accounts. Each T is going to be a different account. And again, I'm going to send you out a chart of accounts. As many times as I taught this, and as long as I've been in accounting, there is no simple way to explain to you, like I had with the normal balances, to help you out with the rules of debit and credit, of figuring out what an account is by name. Yeah, I know I said you can tell by it. With experience, you'll be able to tell by the name of the account. In fact, early in the textbook, they just about every expense account, they'll say, instead of salaries and expense, which everybody in accounting would understand as salaries and wages, which is an expense account, they're going to call it salaries and wages expense or wage expense or salaries expense. Rent expense, Now be careful, rent and interest. You have to pay attention when you encounter those because depending on what side of the transaction you're on, it can be an expense or a revenue. Okay. If you're the bank holding a loan, the interest coming in is revenue. The person, the client, the business that is paying interest on the loan, it's an expense. Same thing with rent. If you're the landlord, rent is income or revenue. If you're the tenant, rent is an expense. But you can always tell by what the words, you're either paying rent or you're receiving rent. You're either paying interest or receiving interest. So you got to be careful on which way it's going. Is it coming in or going out? Again, I'm going to send out a chart of accounts that is arranged. Accountants are notorious because we're logical, reasonable people of putting things in order, and it's very important. The chart of accounts will have sections for assets, liabilities, equity, revenues, and expenses. And under this chart of accounts, there's one in the textbook that's a very rudimentary one. I send you one that's a little bit more extensive, and they'll have a name of accounts, and they'll have a little explanation of what that account collects and holds and what goes in and comes out of it. For example, the first asset is always cash. Cash is an asset. It's something we own. Okay. When we collect cash, we're going to, let's see, here's how it works. Let me fold this up so we don't have to get distracted by the other thing on this paper. So, with Sheena bringing $3,000 into the corporation, we're recording this transaction as for the corporation. So cash is coming in. Cash is an asset. I know that because I've been doing this for 50 years. You're going to have to get used to it. Cash is an asset. So we're going to increase cash by that $30,000. The corporation is going to issue her common stock. So let me see if I can find my stuff I did the other day. Let me stop the tape and have to look around here. I had it 15, 20 minutes ago. Hold on. Be right back. Here it is right under my one clipboard here. That's why I couldn't find it. It's right in front of my face. So here's the entry we did when she made the initial investment, the first transaction of the company. The company got cash. Cash is an asset, so it gets debited. The company issued her common stock as evidence of her ownership of the company. How much stock did she get? $30,000. How much cash did she invest? $30,000. I'm going to give you some rules for writing journal entries. If you notice, when you ever write a journal entry, you always write the accounts being debited first. You can write the credit first, but you have to leave a line up above for the debit account being debited. The credits are always indented slightly. And then we have columns on this side for the debit and the credit amount. Okay. So this is an asset. We're increasing. The corporation is getting $30,000 in cash, so it's increasing. So the normal balance of an asset account is a debit. The normal balance of an equity account, common stock is an equity account, is a credit. That's why we did the journal entry like this. Okay. So let me get another thin sheet of paper here. I'm going to give you rules for writing general journal entries. Sometimes they'll just be called journal entries. First rule, most important rule, the total of the debits must equal the total of the credits. Always. Why? Not because I say so, but because everything is predicated on the accounting equation. Assets equal liabilities plus equity. Okay. Now I'm going to put a little spin on this accounting equation. I'm going to put a 3-prong fork or whatever you want to call it over here. And equities are going to be increased by revenue accounts because they make the company bigger, are decreased by expenses and decreased by dividends. Now, what do we have there? We have 6 accounts, 6 types of accounts that correspond to the basic 6 types of accounts we have on our little note card or cheat sheet here that shows the normal balances. Now, again, I may have mentioned this in the last tape. These are what you do to increase these types of accounts. So number one thing is we have to identify the account correctly as to what type it is. If we're going to decrease it, you do the opposite. Okay, just flip-flop them. Now look at, I think I mentioned this last time too. Look at these things. Because of this accounting equation, the equal sign, assets are things we own. Liabilities are things we owe. They're kind of the opposite of each other. Look at expenses and revenues are on opposite side of this T account. Yeah, revenues are cash inflows. Expenses are cash outflows. You know, whether we work for, we get paid cash or get paid on a receivable that will be turned into cash, it's a revenue. It's cash coming in, either at the present, at the time of sale, or subsequent to. The expense, again, when we pay the expense or when we incur the expense and incur a liability, it's going to have to be paid off. It paid off now or paid off in the future. It's an expense. It's cash going out. Equity is the owner's investment or contributions and growth of the company, and we'll see. Dividends are distributions to owners. Equities are for owners, from owners. Okay? So, there's that nice balance in there. Everything has the rules for general journal entries. 2. The account or accounts being debited are written first and up against the left margin. The account or accounts being credited are written below the debits and indented to the right. I don't know if you remember, and I don't know if I said it, but I think I did in our first video, that debit and credit are just the accountant's way of saying left and right. A debit does, by itself, debit and credit do not mean increase or decrease. It is a function of what type of account you're using. If you're increasing an asset account, it'll be debited. If you're increasing a revenue account, it'll be credited. So whether it increases depends on the normal balance, and that's what increases these types of accounts. To decrease them, you would do the opposite, just flip it over, okay? Debits and credits. Now, when I wrote this second rule, I said account or accounts. Every journal entry must have at least one debit and one credit, and they must balance. If you have one account being debited and one account being credited, it is called a simple journal entry. There are, with Smart Touch Learning, we had transaction 6 down here, where we had 2 accounts, 2 expense accounts being debited, and 1 account, cash, being credited. That's a compound entry. Whenever you have more than one debit, one or more than one account being debited or more than one account being credited, it's a compound entry. Even regardless whether it's a simple entry or a compound entry, the total of the debits, the amounts, and the total of the credits, the amounts, have to be equal because it's all predicated on the accounting equation. Again, you're going to get sick of hearing me repeat some of this stuff. Okay. Third rule. Skip a line between recording transactions. You can see that's what I did. Here's transaction 1, the debit and the credit, the account, the name of the account being debited, the name of the account being credited. Then I skip a line, and then I will go down to transaction 2, the name of the account being debited, the name of the account being credited. Now look what happened here. They're both assets. One asset's going up. We're getting land. We're giving up cash. We're exchanging one asset for another asset. So yeah, the normal balance, what's getting increased? The land is getting increased, so it gets the debit. What's getting decreased? Cash. Cash has a normal debit balance, but we're decreasing it, so we have to credit the asset called cash. So once again, to repeat, write the debit first, the account being debited first, the amount goes in the debit column, the left-hand column, the name of the account getting credited is written underneath the account, name of the account or accounts being debited, and indented slightly to the right, and the number or the amount is in the right-handmost column, the credit column. Now, early on, the textbook does put explanations in parentheses under the entries. You can do that if you want to. I don't need to. When we have an exam and you give me entries, I know I can read what an entry means. Give me some credit for having some education and experience in the field. Okay. Now, what we do in accounting is every time we have a transaction, we want to record it in the general journal, or some people will just say the journal, do a journal entry to record the transaction. Now, the only order in which the transactions appear in the general journal is in chronologic order as they occur. The accounts are going to be spread all over, all different types of accounts all over the place. Could we prepare financial statements, which is our goal, from the general journal entries? You could, but you wouldn't want to. It would be very, 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 did I get enough varies in there? Very tedious. Yeah, very tedious. So what we do periodically, after we record the transactions in the general journal, we write the journal entries. We are going to take that information and we're going to post it to the individual accounts. So I'm going to do that for you now using the 9 transactions we saw in chapter 1 that are repeated in chapter 2, and I think they also add some to it. Let me just again stop the tape and make some darker cheese on this thing here. Hold on, I'll be right back. All right. What I did, I made the T accounts a little bit bolder. I used a marker instead of an ink pen, and I put names on each individual account. Now, this is a collection of accounts. I have I have 9 here, but I screwed 2 up. So I scribbled over them. A collection of accounts is called a general ledger. Okay. General journal is where we record the transactions. We write the journal entries. Get all that stuff in for a week or a month, and it gets all this information. It has the name of the accounts, it has the amount, and again, the only order there is chronologic order. So we're going to take this information from these journal entries, and we're going to put it into the individual accounts that are contained within the general ledger. They're called ledger accounts. We'll just call them accounts for short. So, and I'm going to reference these. Now, the other thing you'll see when I send out the copy of the chart of accounts is they run in order. The assets are listed first. And if you notice in the left-hand column, there's going to be an account code. Assets are always designated with either a numeric or a alphanumeric coding, but the assets will always begin with the digit 1. Liabilities with the digit 2. Equities with the digit 3. Revenues with the digit 4. Expenses with the digit 5. I've seen some computerized system that will have that had a 36 or 38 alphanumeric code for each account. Why would you have so many accounts? Well, if you're tracking payroll, you can have a payroll for, if you have 2 different plants that work 3 shifts, you can have a payroll account for each shift at each plant. That would be informative if you want to do an analysis of overtime, or how much wages are at one plant to get a certain level of output versus the other. All kind of stuff for managerial purposes, not for financial accounting purposes. For financial accounting purposes, you might want to keep track of different plant payroll for different taxes, okay, because different tax rates, things like that. So when you see the chart of accounts, they have a number to them. So I'm just going to put some numbers on these, and I don't have a posting reference column in that. What I'm going to do, we don't have dates either in these things yet. We will have dates. On paper, I'll send you, there'll be a room for a date column. We're just going to reference these with the transaction number for now. But I'm going to put a pink marker here so you can see the asset accounts are in that group. Well, I guess I should make it inclusive. Oh, I don't have another color marker here. We have one liability account. I'll circle in red. Let me see if I can go in the other room and get a different color marker. Be right back. Okay, using a little color here. Hopefully it comes up on the screen. The ones in pink are all asset accounts. This one I have circled in red is a liability account. The green down here are equity accounts, the common stock and the dividends. The dividends, don't forget, is a negative equity. Common stock comes contributions, investments from owners, dividends, payments to owners. Down here in the blue, I have a revenue account, service revenue. And here, faint yellow, you can see the two expense accounts. So now we're going to post those transactions that we saw in Chapter 1 that repeat themselves in Chapter 2. So here's the first entry, the one where Sheena Bright started the corporation by transferring $30,000 from her checking account to the corporate account. So we're just going to take the debit. If it's a debit in the general journal, it's going to be a debit in the general ledger account. If it's a credit in the general journal, it's going to be a credit in the general ledger account. So we have cash. So I'm going to put a circle here with a 1 in it, $30,000 debit. There's the cash debit, 30,000. There's the cash debit, 30,000 in the cash account. Now, also, there was a credit, $30,000 common stock in the general journal. It's a credit in the general ledger. Okay. Transaction number 2, the land is increased. The asset, it's an asset, so it gets increased with its normal balance of a debit, $20,000. And we paid cash. Cash is also an asset, but it's going down. We're paying it. So we're going to credit cash for $20,000. Here's the journal entry. Debit to land, credit to cash. They're both assets. One's going up, one's going down. Here's the asset land. It's going up, 20,000. Cash is going down with a credit of 20,000. Right now, the balance of the cash account would be $10,000 debit balance. Transaction 3, we bought the office supplies on account. So the asset called office supplies is increased by $500. It's a debit in the general journal. It's a debit in the general ledger account. We didn't pay for them, but we promised to pay for them, so we incurred a liability of $500. Accounts payable. So here's the office supplies, the debit. They're being increased because we're buying them from the office supply store. We didn't pay them, but we promised to pay them, so we have an obligation to pay them. It's a liability of $500. Transaction 4, we did some work for some people. They paid us cash. Cash is an asset, gets increased with the debit. Service revenue is a revenue account. Gets a normal balance as credit. It gets increased with the credit. So cash went up $5,500 in transaction 4. And service revenue gets a credit for $5,500. Transaction 4. Cash gets a debit. Service revenue gets a credit. Transaction 5. We did some work for people, for customers or clients. They didn't pay us, but they promised to pay us. Again, the service revenue is going to get increased with the credit. That's its normal balance. We're not getting cash, but we're getting their promise to pay us cash at some future point in time. That goes into an asset account called accounts receivable. $3,000. And service revenue, $3,000. So the asset gets increased with the debit. it was a debit in the ledger or in the journal. It's going to be a debit in the ledger. Service revenue, $3,000, just like when we got paid cash, except now we're getting future cash. That was 5.6. We paid office rent and salaries expense with cash. Both expense accounts, the normal balance is debit, so they get the debit, office rent, salaries expense. We paid them with cash. Cash is an asset. It's going down, so it gets a credit. It's compound entry. No problem. Same rules apply. Whatever it is in the general journal, that's what it's going to be in the general ledger account. So let's see, office rent would be transaction 6 for $2,000. And salaries expense, transaction 6, $1,200. Debit and a debit, $2,000, $1,200, total $3,200. The $3,200 was a credit to cash. So there's a credit to cash for $3,200. It balances with the two debits for the two expenses. Oop, caught it before it hit the floor. Transaction 7, we paid $300 towards the balance we owed to the office supply store. So that's going to reduce our liability, accounts payable, by $300. It's a credit. Hope you're not getting dizzy. There's the liability, accounts payable, that was established up in transaction 3. Accounts payable was increased. Now we're decreasing it because we're paying some of the money we owe. $300. And how are we paying it? We're paying it with cash, a $300 credit, decrease to cash, because cash is an asset, has a normal debit balance. We want to decrease it. We do the opposite of its normal balance, so we'll credit it. Okay. Transaction 7. Transaction 8. Some of the people that we provide service revenue to with some training, they paid us. We get $2,000 payment from those people. Transaction 8. So that's a credit to cash. And a debit to cash and a credit to accounts receivable, because they made partially good on their promise to pay us. We're getting cash and we're reducing the receivable. They owed us $3,000. They owed us $3,000, paid us $2,000. Here's the $2,000 coming in. And finally, dividends were paid to Sheena Bright, $5,000. Transaction 9. And that would reduce cash by $5,000. Transaction 9. Okay. So there's the dividends. They're found in the equity, although they're a negative equity account. So the normal balance is a debit. And there's the offsetting credit. How did we pay the dividends? We paid them in cash. Okay, so now what we have done here, we have taken this information that is in chronologic order, but helter-skelter order with the accounts. And it's this exact same information. But now we have all the debits and credits that affected each individual account in one place, in that account. So now what we have to do is we have to balance these accounts. So all you do is total the debits and total the credits, and then whatever the balance is, put it on that side. And what I'm going to do is I'm going to draw a little line underneath. Now, a lot of these only have one entry. A couple of them have two. This has 7 entries in cash. You're always going to find that cash is a very active account. So I have, let me go get my little handy dandy calculator. Okay, handy dandy calculator. So in cash, we have $30,000 in debit and another $5,500 plus $2,000. And that gives me $37,500 in debits. And what do I have in credits? 23,200 plus 5,300. 28,500. So what I did, I added up the debits and I added up the credits and I put it in very small numbers. I did a subtotal here. This is called footing in accounting, pencil footing. Now, 37,500 versus 28. So the balance, the bigger balance, it's going to be a debit balance, and that's good because that's a normal balance of a cash account. $37,500 minus 28,500. It's a $9,000 balance in cash. So what I do, I write it in bigger numbers. It's a debit balance. I put it on the debit side and I put a double underscore under it. The office supplies, there's only one entry, so the balance is $500. The receivables, I have a $3,000 debit and $2,000 credit. So I have a $1,000 debit balance. I'll write it in here. Land, only one transaction, so that's the balance. Accounts payable, $500 credit, $300 debit, so I have a $200 credit balance. Common stock, one entry. Dividends, one entry. Revenues, $8,500. So all I did was go through each account and determine the balance of the account. Common stock only had one. Dividends only had one, so those are the balance, double underline. And then we have the service revenue. I had two credits, so I add them together. Gets, what is it, 8,500. The expenses only had one entry each, so that's their balance. Now what I'm going to do next is the processing. Well, actually, taking the information from recording the journal entries in the general journal. That's the recording part of the definition of accounting. We also said we're going to record information, we're going to process that information, and we're going to communicate that information. Well, writing the journal entries is the recording part of it. When we're taking that information from the general journal and putting it into the general ledger accounts, we're starting the processing. The second part of the processing is to take the information. Now, each a general journal book, whether it's a manual book or if it's in a computer, you'd have a page for each one of these, or a file or a sheet in a file for each one of these accounts. Okay. Now it's kind of, here it's all on one paper, but I would have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10 different pages, one account per page. So now I want to take that information. I want to summarize it, break it down even smaller, and get it all on one page. And we're going to do what we call a trial balance. This is going to be our first formal statement. So it's always the heading. The first thing of a financial statement is the heading. The name of the company, Smart Touch Learning. Inc. Then the name of the statement. In this case, it's a trial balance. It's intermediate. It's not a formal financial statement. And I don't know what the book uses. Let's use December 31. I always put a time frame on it. December 31, 2022. Okay. There's the heading. There's the name of the company, the name of the statement, and the time reference. Okay. Now we're going to have a column for debits, one for credits, and then another one over here for the account. Okay, the name of the account, and the debit balances will be here, the credit balances will be over there. Okay, let me put a line down here so it makes it look a little bit easier to the eye. And I have 10 accounts and I have made more than 10 lines. But basically what I'm going to do, what a trial balance is a listing in order of all the accounts in the general ledger that have a balance other than zero. So I'm going to write them down. Cash, $9,000 debit balance. That came right out of the general ledger account. Cash, $9,000. So to save time, I'm not going to put this clipboard up. I'm just going to write them all down in order in which they appear in the general ledger, and that would be parallel to what is in the chart of accounts. Give me a minute or two here. Accounts receivable, $1,000 balance. Land, $20,000. Accounts payable, it's the first credit balance, $200. Common stock, $30,000 credit balance. Dividends, debit balance of $5,000. Service revenue, credit balance of $8,500. And then our two expense accounts on the bottom, office rent, $2,000, and salaries expense, $1,200. So there, I just took all the accounts in order from the general ledger and their balance, whether it's a debit or a credit balance. Now I'm going to add up those two columns, cross my fingers, and hope they equal. They should, if I didn't make any mistakes. Slide on here. Nope, that's out. Let's see. 100 plus 1,000 plus 8,200. 38,700. $38,700. I'm happy it balances. So I add them up. I get 38,700 in debits, and I get 38,700 in credits. Okay. So now let's look at what we did. We recorded the transactions. The only order here is chronological. The accounts are helter-skelter all over the place. I took this information from the general journal, put it into the general ledger accounts, summarizing it, condensing it, and then I took the balances. And then I further processed it by putting it into a trial balance. All three of these have the same information, but in a slightly different format. It's important. Could we produce financial statements from this? We could, but it would be, like I said, very, 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 very difficult. And prone to making a lot of mistakes, pulling your hair out. Could you do it from this? Yeah, it would be a lot easier, but still be a little hard. But by condensing them further, summarizing them again into a trial balance, I've got the same information, and it's a lot easier to work with this than it is with 10 pages in the general ledger. Not only that, but the trial balance gives me, the trial balance does one thing. All it does is prove that the debits and credits are equal. It does not guarantee in no way, shape, or form accuracy, because if I made a mistake, it's still possible to balance because I have something in the wrong account. It just tells me that the total of the debits and the total of the credits that I recorded in general journal, transferred to the general ledger, are equal. And that's it's sort of like a negative assurance, but it's a pretty good starting point. Because if it's not in balance, your financial statements are going to be off. Okay. You could still make a mistake because of putting something in the wrong classification, wrong account. But at least here you have a chance on things balancing. All right. We're getting close to the end. One thing crossed my mind and I forgot what it was. Hopefully I can remember what it was. Well, it'll come to me and I'll have to put on next tape. There's something about the financial statements. We have to do them in order. Income statement first, statement of retained earnings, and balance sheet. Oh, that's what it is. Yeah, I'm glad I went over that. And statement of cash flows. Here they are here. These financial statements, and we listed them and we defined them, and that's all well and good. One thing I neglected to say earlier is the income statement, the statement of retained earnings, and the statement of cash flow are all for a period of time. For a month ended or a year ended, usually a year. You have to do financial statements at least once a year. Some companies do them quarterly, every 3 months. Some companies do them monthly. Okay, but the heading would be Smart Touch Learning income statement for the year ended December 31, 2022. Same thing with the Smart Touch Learning statement of retained earnings for the year ended December 31, 2022. Statement of Smart Touch Learning statement of cash flows for the year ended December 31, 2022. The balance sheet is the only financial statement that is different in the respect that it is for one point in time. Income statement, statement of retained earnings, statement of cash flows are for a period of time. It's like a movie, has a beginning and an end. Okay. The balance sheet is for a point. It's like a snapshot. Okay. A single frame of a movie. And we'll talk about that probably next tape when we do some of these statements. In fact, we got a little bit of time. I can do these statements now quickly for you because it's very simple here. Don't have a lot of transactions, and I have all the information I need right here in the trial balance. Now, if you look at the trial balance lists the accounts in orders, and the order follows and parallels what's listed on the chart of accounts, and you'll see that when I send it out to you. But if we look at, let me get something a little bit stronger here. I'm going to show you something about how these accounts are organized. Well, we already talked about that. And you'll see that on the chart of accounts. Okay, we have 1, 2, 3, 4. That's not a very good point on this thing. I should have used the pen. Up here, assets, we have, or accounts, we have cash, office supplies, accounts receivable, and those are all asset accounts. We have one liability account, accounts payable. We have 2 equity type accounts, common stock, and the negative one, dividends. then we have the service revenue, and then we have the two expense accounts. So everything is pretty much in order. We have to do the income statement first. So all we're going to need down here are the revenues and expenses. I'm just going to abbreviate STL for Smart Touch Learning and Inc. statement. And then for the year ended December 31, 2022, income statement. And then I'm going to have revenues at the top. And then I'm going to have expenses underneath it. I'm going to show you the shell before I fill it in, because that's the format of an income statement. The revenues are always shown on the top, then the expenses are listed underneath, and then you compare the totals. I'll show you a little trick to make it a little bit more user-friendly. Service revenues, $8,500. Expenses, office rent, and salaries. Expense. Office rent is $2,000, and the salaries were $1,200. I have the revenues up here. I'm going way over here with them. The expenses, since I have several, I'm going to bring them over here, and then they'll have total expenses right underneath there. You'll see how nice it looks. And let's see, real good here. I could do it in my mind faster than I could have reached over for the calculator. $5,300. And we're going to call it net income. You had $8,500 in revenue, $3,200 in expenses, total expenses. And since revenues are greater than expenses, the $5,300 is a positive number, so it's net income. If it was a negative number, we would call it net loss. Now, Smart Touch Learning, statement of retained earnings. And I'm going to abbreviate. You should never do this on a financial statement, but I'm running late on time here. Now remember, Smart Touch Learning was just started this year, so the beginning retained earnings at the beginning of the year were $0. January 1, 2022, $0. We had net income, so we add net income of $5,300 from the income statement. That gives us a subtotal. Some accountants will call it subtotal, some will just leave it blank. So there's our beginning retained earnings, beginning of the year, first year of the operation. Then add net income, add the subtotal. Now we're going to subtract out dividends. We're going to say less dividends. I get those right off the where are they? Dividends right off the trial balance. All this information is coming off the trial balance. So my retained earnings at the end of the year is $300. And my penmanship is going to heck because I'm going real fast. So here's the heading, Smart Touch Learning, abbreviated, statement of retained earnings, abbreviated, for the year ended December 31, 2022. Beginning of year, January 1, 2022, retained earnings were zero. Add in the net income, subtract out the dividends, get $300 end of year retained earnings. Now to do the balance sheet. So once again, I have a heading. I'm going to abbreviate STL for Smart Touch Learning. I'm going to call it balance sheet. And as I said a few minutes ago, it's good for a point in time. So I'm going to say December 31, 2022. I'm not going to say it. Doesn't say for the year ended. It says at December 31 because December 30th and January 1st, it's going to be something different. So I'm going to give you a skeleton look, and then I'm going to fill it in. We're going to have liabilities, total liabilities, stockholders' equity, total stockholders' equity. And then we're going to combine those two, and we're going to have total liabilities and stockholders' equity. And hopefully those two numbers will agree. Here's our major classifications. We're going to have the assets up the top. Down the bottom, we're going to have the liabilities and stockholders' equity, and broken out liabilities, total liabilities, stockholders' equity, total stockholders' equity, and then we're going to add them up, and hopefully, as the name implies, get a balance sheet that balances. So again, going back to my trial balance, what do I need? I need the asset accounts, I need the liability accounts, I need the the equity accounts. The one that's not on there that I need, but I figured it out by doing the statement of retained earnings. So we have our assets, we have cash, office supplies, accounts receivable, and land. One, two, three, four. Okay. So what do I have? Cash here of $9,000 coming off the trial balance, $500 in the office supplies, $1,000 in the accounts receivable, and $20,000 in land. Let's see, that'd be $30,500. Don't even need a calculator for it. 20, 9 and 1 are 10. That'd be 30,500. Call that total assets. All I did was go to the trial balance, write down all the asset accounts I have and their balances, and then add it up, call it total assets. Liabilities, I only have the one, accounts payable. And that was $200. So I list the liability and then total liabilities over here. I just bring that down and over. Stockholders' equity, I have common stock, $30,000. And I have retained earnings, and I think I'm all right here. But now where I get the retained earnings from is not the trial balance, but from the statement of retained earnings. Let me go back to my statement of retained earnings. there it is, $300. I made 85. I made 5,300 and paid 5,000 in dividends, so I'm losing 300 in retained earnings, which is a equity account. Oops. 30,300. And I have 30,500. So I put in the liability, total liabilities, only had one. Stockholders' equity, I had common stock and the retained earnings at the end of the year because we're dealing with December 31. Okay, so I have total stockholders' equity of 30,000 in common stock, 300 in retained earnings for a total of 30,300 plus a 200 liability, 30,500. Total assets, 35,100. They equal. It balances. Hooray! All right, see you in the next video. Thank you.